Life insurance. You know, for most of us, we think we know what it is. It's a safety net, right? But what if I told you it's also being pitched as one of the most powerful wealth-building secrets out there? A system the ultra-rich supposedly use to create tax-free fortunes. Today, we're going to peel back the layers on this really complex financial product to figure out if it's a golden opportunity or a very, very expensive trap.
And that question right there is really what this is all about. There's this strategy going viral that promises to let you become your own banker. I mean, it sounds like a financial cheat code, doesn't it? But as we're about to see, the truth is always in the numbers. So, to make this all make sense, let's follow the story of a guy named Ethan. He's probably a lot like many of us, 30 years old, working hard, making a decent living, and just trying to find the smartest path forward. He really wants to build something meaningful for his future, not just get by. Okay, before we dive deep, we've got to do the quick but super important disclaimer. This is for educational purposes only. It is not financial advice. You should always talk to a qualified professional who actually understands your specific personal situation. All right, let's get into it.
So one night, Ethan's doing what we all do, just scrolling online. And he comes across a video. You know the type. A confident presenter, a whiteboard, and a message that just instantly grabs him. It's a strategy called infinite banking. And the pitch? Wow, it is compelling. The idea is you use a whole life insurance policy to build up this pool of capital. They call it your cash value. Then you can borrow from your own policy to fund investments, buy a car, whatever, all while the money inside supposedly just keeps on growing. It sounds like you're using the same dollar in two places at once. For someone like Ethan, it feels so strategic, so smart. So after talking with an agent who shows him these impressive charts, with lines just going up and up, showing compounding dividends and rising cash values, Ethan's sold. He commits. He's got to put in $750 every single month. Now, on a $70,000 salary, that is a serious commitment. We're talking about 13% of his gross pay, all tied up in this one strategy. So Ethan starts making his payments, right? He's expecting this wealth-building machine to just fire up and start humming. But what's actually happening under the hood? Well, it's very different from that slick presentation. Okay, let's break this down. When Ethan pays his $750 premium, that money doesn't just go into a savings account with his name on it. No, it gets sliced up. A piece of it pays for the actual life insurance, the death benefit. Another chunk covers the company's operating costs. And a significant piece goes right to the agent's commission. Only what's left over actually starts building his cash value. And the size of that commission is what is truly staggering. In the first year, the agent can earn anywhere from 70 to 110% of the entire first year's premium. So for Ethan, that means of the $9,000 he puts in, up to $9,900 could be going to the agent. This is the single biggest reason his cash value growth is so painfully slow at the start. And you see the impact of that commission immediately. After one full year, he's paid in $9,000, but his cash value is only around $6,300. He's completely underwater. Even after 3 years, he's still behind. It usually takes 5 to 7 years just to break even, the point where your cash value finally matches what you've paid in. And honestly, this is when a lot of people just give up, they let their policies lapse, and they often walk away with less money than they put in. This slow start really begs a crucial question, doesn't it? What if Ethan had used that same $750 a month differently? Let's explore the classic alternative that you hear financial advisors talk about all the time.
It's called the buy term, invest the rest strategy. And it's super simple. For about $30 a month, Ethan gets a term life policy. That covers the death benefit for his family, the protection part. Then he takes the remaining $720 and just invests it consistently into a low-cost index fund that tracks the stock market. No complex layers, no crazy upfront costs.
So now we've got two paths. Same person, same money. Let's hit the fast forward button and see how these two strategies really stack up against each other over the long haul. This is where the power of compounding really starts to show itself. After 10 years, the whole life policy is finally starting to perform. It's chugging along. But the index fund, even using conservative growth numbers, has already pulled significantly ahead. That early drag from commissions and all those fees created a gap, simply because more of his money was actually working for him from day one in the market.
Now let's jump ahead to the 20-year mark. And wow, the gap has widened dramatically. The whole life policy has grown nice and steady, but the index fund's value is now roughly double the policy's cash value.
This is just the unforgiving math of opportunity cost and compound growth at work. And at 30 years, the difference is just staggering. Ethan has put roughly the same amount of money into both strategies over 3 decades. One path has led him to about $500,000. The other path, the simpler one, has led him to over $1 million. This chart just puts it all into perspective, doesn't it? The first bar is what Ethan paid in. The blue bar is what the whole life policy gave him back. And that orange bar, that's the potential of the index fund. For somebody building wealth from the ground up, that difference isn't just numbers on a screen, it is absolutely life-changing. Now, looking at those numbers, you might think, okay, case closed. This whole life insurance thing is a bad deal. But that is not the whole story. The numbers don't capture everything, and these policies do have some unique advantages that are really valuable to certain people.
No, not at all. The debate isn't really about whether the product is good or bad. The product itself is solid. The real question is, who is it actually designed for, and what problems is it really meant to solve?
And here are those powerful advantages. The cash value growth is guaranteed. It will not drop in a market crash, which gives you incredible peace of mind. It forces a savings discipline, which is great. And most importantly for wealthy people, you can take tax-free loans against your cash value without selling your assets. This is huge for business owners, and it's a cornerstone of complex estate planning to pass wealth on tax efficiently.
And this brings us to maybe the most important point of this whole explainer. Financial products are just tools. That's all they are. And using the right tool for the right job at the right time, that makes all the difference in the world.
So here's the crucial point. Whole life insurance, especially in this infinite banking context, is typically not a wealth-building foundation. It is a wealth optimization and preservation tool. It's what you use after you've already built a strong financial base, not as a replacement for one.
For most people who are in that wealth-building phase, like Ethan, the priorities should look a lot more like this. Step 1, get an affordable term insurance policy for protection. Check. Step 2, get that free money from your employer's 401k match. It's a must. Step 3, max out a Roth IRA for that amazing tax-free growth. And then, anything left over, put it in a simple, low-cost index fund. These are the foundational moves that do the real heavy lifting.
So we end where we began. Infinite banking isn't some scam. It's a legitimate strategy that works, but it works for a very specific person, usually a high-income earner who's already maxed out every other tax-advantaged investment account they have. The ultimate question isn't just, does it work? It's, does it work for you, right now? And knowing the difference between a tool for building a foundation and one for preserving a legacy, well, that's the first step to building real, lasting wealth.